Our next guest is delivering a grim picture of the inflation fallout. Jim Bianco runs Bianco Research. Jim, great to see you.
Thanks for having me.
So you think 100 basis points is in the cards for July. What sort of environment are we entering in terms of the economy at this point with 100 basis points on the table?
Yeah, and the market is pricing in about a 70% chance now that the Fed is going to go 100. That was like 5 before the number this morning. And it's pricing in another 75 on top of that 100 at the September meeting. So you're looking at a 3.5 funds rate by the middle of September. And the reason is the Federal Reserve, I think, has made it abundantly clear job 1, job 2, job 3 is going to be bring inflation down. If the economy slips into recession, and the inverted yield curve might be signaling that, or if the stock market struggles, it slips into recession and it struggles. They're going to focus on inflation. That's their job. And so right now, we're in a situation where good news is bad news. So when you get a strong payroll report, when you get any kind of strength in any of the numbers, that just opens the Fed up for more rate hikes. And that's why we've got 100 basis points. It wasn't just the CPI number that did it. It was also 373,000 jobs last Friday that opened the door for that.
Jim, every once in a while, I mean, in the old days, you see these emergency rate cuts in between meetings. I mean, it seems to me 9.1 handle is a bit of an emergency situation. Why would they wait? Why don't they just come out and do it? What's the point of waiting till the meeting?
I think it's optics. I think it's optics that they don't want to look like they're panicking, although you could argue, what is 100 basis
No, hold on one second.
hike?
No. I got it. Let me push back on that a second. I hear you. They're long past optics. I mean, the days of them in optics are way gone. I mean, that ship has sailed. So if they're worried about optics, they're worried about the wrong things because they have zero credibility left. Sorry to interrupt you.
No, you're absolutely right. I was going to say, what's the difference between an intermeeting move and a 100 basis point hike? It still kind of portrays the same thing. But you're right. They're so far behind the curve. Every rate hike campaign has always ended with a positive real yield. That means interest rates above the inflation rate. Now, inflation's not going to stay at 9%, but it's not going to 3. It might go to 5. It might go to 6. And every rate hike campaign will have to end with a positive real rate. They've got a long way to go. That's why I think that the 100 basis points is coming, and I think why the market has struggled. I'll give you one fun statistic. Only 3 up weeks in the last 13 in the S&P. Go back to 1928. That ties the record of futility for the least number of up weeks over any 13-week period.
Jim, you say stagflation is a possibility. What do you think the odds of stagflation are today versus, say, the last Fed meeting?
Oh, I think, the odds of stagflation are probably 100% right now.
100%?
You got 9%.
Okay.
Well, let's define stagflation, right? High inflation, 9% inflation, low growth. The Atlanta Fed is telling us that we might see another negative number, another consecutive negative number. If it doesn't go negative, it's just going to be barely positive. That's your definition of stagflation. Now, the comforting news about stagflation is it's a situation that doesn't last long, maybe a quarter or 2 or several months, but it doesn't go on for years and years. But it's going to be a very challenging environment. And it's going to be challenging for the Fed because they're going to be pulled by 2 different things. They may raise rates 100 basis points on July 27th, or maybe 75, I think 100. The next day is GDP. And it could very well be negative or under 1%. And, guys asked me about optics. How about that? Raise rates 100 basis points, and 24 hours later, we get a negative GDP report. They are in a very difficult position, but I think when they look through it all, their focus is going to be on inflation, and that's going to spell trouble for markets because the Fed's not their friend. The Fed is their enemy right now until this inflation thing goes away.
So stagflation lasts 1 or 2 quarters and is a short-lived situation, Jim. What's the other side of stagflation? Is it necessarily economic growth?
It can be, because what stagflation should do is it should break the back of inflation. And we should then start to see the economy. Look, I've argued we're in a post-pandemic economy. What that means is we got to stop thinking about 2019 returning. It's not. We have a different economy. Don't confuse that with dystopian. It's different. And once we start understanding that and restructure the economy for the new post-pandemic economy, we can get out of this. Unfortunately, we spend too much time fighting whether or not there actually is a post-pandemic economy. You know, a lot of the real estate guys in Manhattan are just saying, you wait, everybody's coming back to the office. No, they're not. And the sooner as we figure out why they're not and we move forward with that, the sooner we will get to the post-pandemic economy and we can start seeing normality return to markets, or at least what we think is normality.
Last quick question. This is a one-word answer, I think, Jim, and I'm going to ask the traders this. What's better for the stock market, stagflation or recession?
Probably recession.
Yep. Jim, thank you. Jim Bianco, Bianco Research. Same question to you, Karen.
Agreed. Recession.
Yeah. Bonawyn?
Same.
Guy?
Recession.
Dan?
I don't understand the question. I mean, like what I'm saying, we're going to have a recession and it's going to be stagflationary. I mean, like, that's the point. They're going to be all matched up.
Do the markets trade better with stagflation or recession?
I think it has to be a really deep recession to get a lot of these excesses up. You need to see unemployment go up meaningfully, probably to 4%. It's just at 3.6%. You talk about housing. We need to see real data that suggests that the housing market has broken the fever that it was in. We've seen manias, as far as risk asset manias, break over the last year. We need to see that, and we need to see unemployment tick up. And you can call it whatever you want. It's going to feel like crap either way. So that's the, you know, and the stock market's not going to like it. Stock market bottoms lower than here. We've been talking about this for months and months.
I went to Dan last, by the way, because I knew that he wouldn't answer with one word.